Hey everyone, in this video, I'm going to evaluate the automated chip design company Synopsys and answer whether or not the stock is a buy, hold, or sell for long-term investors. I'll look at the company's latest quarterly financial results. I'll look at its prospects for its current fiscal year. I'll look at the next 5 years, expectations on Wall Street for what its earnings per share will be over the next 5-year period. And I'll also look back at the company's history over the last 5 years, the longer term. How has its profit margin expanded, its revenue? Finally, I'll compare it all against its valuation to determine if the investment is worthwhile for long-term investors. So let's get started with the latest quarterly results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in its latest quarter, in the 3 months that ended April 30th, Synopsys reported total revenue of $1.45 billion, which was up from $1.26 billion in the same time the prior year. The company is very profitable in terms of its gross margin, coming in at $1.154 billion, up from $1 billion in the same quarter the prior year. That healthy gross profit allows the company to invest in research and development, which the company has done successfully. In the latest quarter, it invested $493 million in research and development, and that investment has reached $1 billion so far year to date in its fiscal year 2024. That investment in research development has been fruitful for Synopsys, leading to many intellectual property and to many chip design patents, and that's what allows it to gain strong market share and able to sell its product at premium prices that generate very healthy profitability for the company overall. On the bottom line, you could see here net income increased to $289 million, up from $269 million in the previous year. And over the first 6 months of its current year, net profit has improved even better to $735 million, up from $538 million in the same quarter the prior year. So the company is growing and is growing profitably in the most recent quarter and in the most recent 6 months. Looking ahead for the full year in its 2024, the company is targeting growth rate on the top line of a range between 14.5% to 15.6%, with an operating margin expanding to 38.1% from 36.3% the year before. The company forecasting earnings per share growth of 22 to 23% for the current fiscal year. Now, that comes following a year of 25.5% earnings per share growth in 2023. Remember, Synopsys has a broad market portfolio with electronic design automation and semiconductor intellectual property. Demand for these segments are soaring, and Synopsys is benefiting as a result. Longer term, the company's financial objectives include non-GAAP operating profit margins in the mid 40% range and long-term free cash flow margins in the mid 30% range. Healthy margins in the excellent category of companies like Microsoft, Apple, and those operating profit margins in the mid 40s. Now, the highest operating profit margin is 67% of any company that I follow, and that's Visa. So if you're in the mid 40s, you're really, really good. You're up there among the best of the best. The company is also expecting earnings per share growth in the high teens range. Now, this longer term expectation of earnings per share in the high teens, which is like 16, 17, 18, or 19%, is along the lines of what Wall Street expects from Synopsys. According to Wall Street analysts, they expect it to grow earnings per share at 16.58% over the next 5 years. So along the lines, on the lower end, actually, of what management is forecasting for Synopsys. Now, Synopsys stock price has performed relatively well in 2024, up to $578 per share, up from around $500 per share to start the year. Revenue growth has been robust over the last decade, jumping to $6.19 billion on a trailing 12-month basis, up about triple from the roughly $2 billion it generated in 2015. And those increases in revenue have led to increases in operating profit margin up to 23.42%. You can see that has roughly doubled from the 12% operating profit margin in 2015. And remember, management is forecasting operating profit margins in the mid 40% range. So there's a long way to go from here. And the company has already demonstrated the capability to improve its operating profit margin over a 10-year period. So investors can be reasonably confident that management can hit its target it's setting out for investors, because it's proven a history of doing just that, right? So when a management team has proven something, investors can reasonably be confident in their forecasts for the longer term. This is unlike a company like, for instance, Tesla. When they give forecasts for what they're going to do in the future, I discount those forecasts significantly because Tesla has failed to hit on so many of their targets that they've lost trust from investors, including myself, on their ability to hit targets that they set or deadlines that they set for things like driverless car technology, lower priced models, semi-trucks, etc., etc. I can give you example after example of forecasts that Tesla has missed. So management teams have to earn that trust, have to earn the ability to give forecasts that are trusted by the investor community, and Synopsys is forecasting long-term non-GAAP operating profit margins in the mid 40% range, and that's expected to increase from this 23.42% range. But look at the history, right? They've grown it from 12% up to 23%. So we can be confident, reasonably confident, that they'll continue to make progress on this front. And finally, I wanted to look at its valuation. Synopsys is trading at a forward price to earnings of 38.62. So it's trading at nearly its most expensive valuation it's traded for going back 3 years, according to this metric. So putting it all together, I would say Synopsys stock is a borderline buy. If I was to answer if it's a buy, hold, or sell, I would put it on the borderline. My one hesitation is the expensive valuation. It's trading at nearly the most expensive valuation it's traded for in the last 3 years, according to those metrics. It has excellent expectations going forward. It's in a great position to benefit from the tailwinds in its industry. However, the price is already reflecting a lot of those expectations, and it's still about to digest an acquisition that's not yet completed. So a couple of things make me hesitate when you're trading at such an expensive valuation relative to your past. A lot has to be going just right, and there's a few things that are not excellent for Synopsys right now, primarily the valuation. Otherwise, the performance of the business has been really strong. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.